Good day, everyone. This is still MC the Accountant Shares, and today we are going to discuss about installment sales method, which is the first, usually major topic in advanced financial accounting and reporting. So let me begin by showing to you the learning objectives in installment sales method. By the way, I'm still using the Book of Milan to be able to discuss to you about this particular topic. I understand that there are plenty of sources. Probably I'm going to make use of them too for discussions, but for now, we'll have Milan's book. So here are our learning objectives. We need to know when to make use installment sales method in certain transactions, especially in recognizing revenues and applications, so journal entries, computations, and the like. In addition to number one theories. Introduction. Remember in the previous videos that we discussed about PFRS 15, which is all about revenue from contracts with customers. So we have already indicated there the guidelines, the new revenue recognition model, the application, what specific contracts to be made or to apply PFRS 15. As said, all revenue contracts, all sale transactions will be included. However, with the exception of lease, insurance contracts, and the rest, because there are specific accounting standards in which we are going to make use in dealing with the said types of contracts. So take note that in installment sales method, we deviate from PFRS 15. So the concepts here that are to be tackled are not the specific guidelines under PFRS 15. Instead, these are modifications or deviations, meaning we put an X mark to PFRS 15 and we talk of other things. So I said deviations. So installment sales method for a special type of sale is a deviation from revenue recognition principles of PFRS 15. As said, deviates means we depart. So it departs, it ignores, it disregards the revenue recognition principles of PFRS 15. So allow me also to tell you that if we talk about installment sales, this is a special type of sale since not all companies would be doing this one. So there are specific entities, specific types of businesses in which this forms part of a major portion of sale, but there are some like the normal things that we discuss that installment sales method is just one of those types of sales. So if we say sales, the common types would be cash sales, wherein there's outright payment of cash. So spot cash is to be made. The other one is credit sale or account sale, in which the sale will involve payment at a future date with one-time payment. So those are the two types of sales, account and cash. On the other hand, we need to add more type of sale, and this is installment sale. The word installment means that the payments are done in series. So basically, installment sales mean sales in which the payments are to be made in different time periods. Say, for example, monthly each thereafter the transaction date or the date of the sale. So installment sales is utilized or may be used when under NIRC, this is our law for taxation in the Philippines, that under income tax basis for external reporting, if the reporting entity is a micro entity. So basically, if that is under the law, NIRC tax law, it is used as income tax basis. But then for financial accounting purposes, which is separate from taxation, taxation is another field. This field is financial accounting and reporting. So this is allowed if the reporting entity is a micro entity because there is no specific accounting treatment that is required for a micro entity. So these entities in which their assets are lower than 3 million pesos. Okay, so size test will be discussed further in other accounting subjects. Letter B, when this is a departure from provisions of PFRSS, in which we will really tackle here. But when is this allowed? That is a question that we are going to deal with. Anyhow, what is clear is that if ever the problem does not state the situation, then we are going to make use of installment sales method. All right. So PAS1, which is presentation of financial statements, paragraph 19, that is why it is 1.19. In the extremely rare circumstances in which management concludes that compliance with the requirement in a PFRS would be so misleading that it would conflict with the objective of financial statements set out in the framework, then the entity shall depart from that requirement. So this is the time in which the departure is allowed. And then, in case of the above, the entity shall provide the necessary disclosure. So why are we departing? We need to add more information. Also, under paragraph 18, we have to take note that inappropriate usage of accounting policies cannot be rectified. When you say rectified, cannot be cured, cannot be removed, but just a disclosure. So, in other words, this departure is not a violation of the accounting policies under IAS 8. Okay, so brief history. This is coming actually from US GAAP. So the set of accounting standards used in US or United States of America applicable to long-term installment sales. So normally installment sales in which the payments are done in series, installment means also series of payments. We have real properties, which is really true. It's going to last for 10 years, 15 years, 20, 25, 30. So also personal properties could be gadgets, even intangible items like insurance contracts. So they are to be made in installments, not just goods, but also service. When there is uncertainty in the collection, so if there is doubt in the collection, then this is the time that we are going to make use of installment sales method. But if there is no question as to collectibility, then we have to make use of PFRS 15 as discussed. Next, accounting procedures. How do we compute, or what are the computations here? It's very important for us to know or recall that gross profit is basically the amount that is placed on top of cost to be able for us to gain something in the sales process. So the formula, remember, is sales minus cost of sales equals gross profit. Okay, this one. Sales minus cost of sales is gross profit. And then because the contract is in installment and there might be uncertainty as to the collection, that's why we are going to defer the gross profit. So for installment sales, the illustration here, which is sales minus cost of sales, would be equal to deferred gross profit. And then initially deferred, then we are going to allocate or we are going to amortize the deferred gross profit over the periods that there are collections. So whenever there are collections, then we are going to get the realized gross profit. And that's why the formula is multiplying collections with a gross profit rate. So the gross profit rate is also to be noted because if this is based on sale, it's easy. All we have to do is to multiply it directly. But if this is based on cost, remember it's going to be that rate over 100% plus the rate. So example, if the rate is 40%, so that's going to be 40 over 140. Okay, so that is a discussion in intermediate accounting. So initially, remember to record the installment sales. That is going to debit installment AR or accounts receivable, and you are going to credit. Supposedly, it's going to be really installment sales so that we will deviate it from the regular sales. The regular sales are cash sales and credit sales. Then after that, if we are using perpetual inventory system, then we are going to debit cost of sales and credit inventory, which is another entry. Now, the deferred gross profit account is actually to be recognized later on as we make adjusting entries. So initially, it will not be seen on our journal entries. The moment that we do the adjusting and closing, it will be shown. And we have to take note that realized gross profit is part of profit or loss, and deferred gross profit is part of non-current liabilities. I indicated here are current because it's going to be depending on the situation. Installment accounts receivable is part of the normal operating cycle. So normal operating cycle is also tackled in intermediate accounting under IAS 1. But anyway, if you say normal operating cycle, this is the time in which we are going to use cash to be able to produce products out of the inventories acquired. So cash inventory, then receivables, and back to cash. So even if the normal operating cycle is more than 1 year, supposedly that's going to be long term, but installment accounts receivable are to be presented as short term normally. So if the company is having installment sales as just one area, one method, or one venue in which they can increase or have more sales, then probably it's going to be that the installment accounts receivable will be part of the non-current. The deferred gross profit, on the other hand, will depend upon the type of the sale. Is it current or non-current? By the way, if we say current, it means 1 year or less. Non-current is more than 1 year. So the deferred gross profit would be depending as to whether it's going to be collected or realized. I said collected because if there is collection, then we are going to transfer portion of deferred gross profit to realized gross profit. So in that case, there would be transfer from non-current liabilities to current. So that's why I said or current, depending on the situation. But initially it is non-current, thinking that installment sales will be long-term sales. Okay, next, illustration 1. Installment sales method. So here, to journalize the transactions, so I said first is to recognize the receivable and sale. Second is the recording of inventory transfer because of the sale. So this is the second entry. Should we use perpetual inventory system? And this is assumed, by the way. So remember in financial accounting and reporting that in terms of the two types of inventory, periodic and perpetual, we make use of periodic in first year level. That is because periodic inventory is applicable for small scale businesses like before, prior to accounting systems, but now there are affordable accounting systems. So even perpetual inventory system can be made use of by small entities. For micro entities, probably they're still using periodic inventory system. So that is discussed on lower levels because that is not anyway going to be made use of by our majority of clients in the future. Majority would be using the perpetual inventory system. So in higher accounting, we make use of that. And besides, it's going to be really useful because the perpetual inventory system will take note of the updates on inventories. The second one is on the down payment. For down payment, so that's going to be cash receivable. So when we make payment, we transfer cash, but we are here on the part of the seller. This is installment sales. And that is the reason that we will debit cash and credit installment sales. Okay. And then these are the collections. So it's being stated here that 20% was being paid as a down payment. So 1 million times 20%, that's 200,000. So here. And then the rest, which is 800,000, 1 million minus 200,000, 800,000, is to be paid in 4 equal annual installments. So we simply have to divide 800,000 divided by 4, that's 200,000 per year. So this is our collection for first installment for the year 20x1. But there's also down payment. So the total collections will be 400,000 here. This is what I told you a while ago, that we are going to recognize deferred gross profit once we make adjusting entries and closing entries. So here, we close sales and cost of sales. Remember, the normal balance of cost of sales is debit. So if we close it, we put it on the credit side. If sales are to be closed, we put that on the debit side, because sales, which is a revenue account, have normal balance of credit. So take note of rules of debit and credit. And then for the collections, that will be down payment of 200,000 plus the installment equals 400,000 multiplied by the GPR rate on the sales. So we have 400,000 times 40%. So how do we get 40%? We have here sales, 1 million, cost of 600,000. Hopefully that's shown here. It's shown here. 1 million minus 600,000, that's 400,000 divided by 1 million. So deferred gross profit over sales. 400,000 divided by 1 million is 40%. If that is based on sales, so 40%. But if this is based on cost, the basis would be, or the denominator would be the cost over 600,000. So this would be like different rate. Anyway, so if this is based on cost, it's going to be 400 over 600. So that's going to be a different rate. And this is 40%. So 400,000 times 40% equals 160,000. Also, remember that under financial accounting and reporting also, that when the problem is silent, we really assume that it is based on sales. Okay, for number 5, we now have to transfer this realized gross profit from deferred to it. So deferred gross profit is a while ago having balance of credit, because this is actually a liability account. Why? This is an earned income. An earned income is an income that is deferred for the meantime and to be transferred to income as there are collections. So here, credit realized gross profit, which is 160,000. And in profit or loss, this is going to be the presentation. So sales minus cost of sales gross profit. By the way, the sales and cost of sales here would be the regular sales, composed of cash and account, also known as credit sales. We just have to add the realized gross profit coming from installment sales to get the total gross profit. So if this is a situation, the company is having the 3 types of sales: account, credit, that's the same. So account or credit, then we also have the cash, then you also have installment. So meaning this is going to be the section of computation of gross profit for regular sales, and this is going to be the section for the realized gross profit coming from installment sales. So anyway, that's the point or consideration. If you will be asked later on how much is the total realized gross profit from the company, that's going to be the sum of gross profit from regular sales and the realized gross profit from installment sales. There's a modified entry here in which we are closing income summary with deferred gross profit balance. So this is like the ending balance, 240,000. So that's 400,000 minus 160,000. realized gross profit. So this is like one way of presenting our realized gross profit. So you have the gross profit deferred. Now take note that in this situation, it is presented the 1 million installment sales in the same format of the regular sales here. So we can make use of this format just to get the deferred gross profit anyhow. But then if this is like the presentation, we can just disclose in the notes as to how do we get the deferred gross profit for installment sales. So we have here sales minus cost of sales, gross profit is 400,000. This is like the deferred gross profit beginning. And the ending is whatever is the ending balance of the receivable. So that is, we have here, remember 1 million minus 400,000 collections. So that is 600,000. 600,000 times 40% is 240,000. And the difference is 160,000 total gross profit. So this is also another way. I call this normally, this is method 1, in which realized gross profit is simply collections times gross profit rate. And this one is called method 2, in which the realized gross profit is the difference between gross profit beginning and the deferred gross profit ending. Okay, so I hope that is clear. We can also summarize this by saying that realized gross profit is directly proportional to collections, but deferred gross profit is directly proportional to installment accounts receivable balance. So a while ago, I told you 600,000 balance of accounts receivable multiplied by 40%, that is 240,000. Okay, the rate, I've also told you a while ago that the gross profit rate is 40%. This is another way of showing it. Initially, when we compute gross profit rate, that's deferred gross profit over the installment sales. So 400,000 over 1 million is 40%. This is also another way just to check at the end that you are still at 40%. Then if this is installment collection second year, 200,000, so simply multiply this by 40% to get the realized gross profit. And to close, installment accounts receivable is being treated as part of current assets because it's within the normal operating cycle and is a trade receivable. Unless again, it is just one of the 3 types of sales in which it's not part of normal operating cycle, and that's the time that it's going to be, we are going to make analysis, is it short term or long term? But if part of normal operating cycle, current or short term. On the other hand, if we say deferred gross profit, it's going to be long term because we're thinking here of long term type of sales or installment sales. But then if it's going to be outside the normal operating cycle, then we have to analyze. Or even if it is within the normal operating cycle, but the term is just 1 year or less, then we are going to place that under current. Okay, so here are the notes. Remember, if this is PFRS 15, we are going to apply the 5 steps in the new revenue recognition model. And then we have to identify the contract with customer. We have to identify the performance obligations in the contract. Third is we are going to determine the transaction price. Fifth, or rather fourth, because there are 5. Fourth is allocate the transaction price to the performance obligations. And the fifth one is recognize the revenue as performance obligations are satisfied either at a point in time or over time. So we are going to disregard PFRS 15 provisions because installment sales is applicable for long-term sales or contracts with uncertainty, reasonable uncertainty. Okay, but this is just a review. of those provisions. First, if it is overtime, it's based on progress. If it is at a point in time, so there is a clear transfer of management control or relinquishing or releasing of control. Then the third part here is that if there is, for example, payment in installments and there is a promissory note, and that is going to be long term, then it is non-interest bearing. Remember, we are going to compute the present value. If it is interest bearing, the present value is the face amount. Then this part here talks about collectibility. If it is not probable, then we are not going to recognize any revenue yet from the contract. So initially, it's going to be deferred gross profit. So this is where installment sales method is going to be applicable. All right, then collectibility or collectability, which is the same or which are the same, becomes uncertain, then we have to assess for impairment. That's also a possibility, especially for long-term receivables like installment sales, debit is receivable. And if it becomes significantly uncertain, so that's where we cease from recognizing for the revenue and assess for impairment. All right. If it becomes uncertain, so just assess for impairment. But if it is significantly uncertain, so stop revenue recognition and assess for impairment. And then this is, by the way, PFRS 15, and this is also PFRS 15. And then under PFRS 15, so there is the time in which performance obligations will be satisfied, and that's the time also that we're going to recognize the revenue. So the timing of the revenues that are to be recognized would be suspended, would be considered on staggered basis, but overall it will be the same for all contracts. And then if ever there's really a clear transfer of control and there are no doubts as to the collectibility, so at inception date, there would be recognition of sale and the gross profit will be recognized as a whole on the income statement or profit or loss or statement of comprehensive income. But then because of the uncertainty, that's because of the collectibility issues. So in that case, we are going to make use of installment sales method and therefore the gross profit is deferred. If PFRS 15 is to be applied, so sales minus cost of sales is the realized gross profit from the sales. So all deferred gross profit, if outside PFRS 15, would not be considered or applied under PFRS 15. Instead, the entire amount is to be recognized as gross profit. So in other words, this will be treated as a regular sale under PFRS 15. All right, so hopefully you learned something for the first part of installment sales. And please also check out the next series for installment sales for the next discussions that we will have. For now, that's it, guys. And don't forget to subscribe to my channel. Bye for now.